So look, I think what we're trying to say is that, look, in the past, we used to have this synchronous recovery with global trade doing well. You would have EM and DM growth synchronized. And that used to be a great period for the region in terms of trade doing better. That also follows through in CapEx. But what we are seeing now is that we don't have this one big single anchor with trade doing better. And therefore, it's a story of idiosyncratic factors driving various economies in the region, and a more diverse group of countries which are driving region's growth rate. So yeah, it's a different period than what it used to be in the past.
All right, let's get into some of the those factors, those idiosyncratic factors that you talk about. And I guess top of that list always is going to be what Fed policy is next. And certainly there's a lot of idiosyncrasies in the commentary that we hear from them. 1 minute, Jay Powell is telling us that things are looking reasonably stable and positive. And the next minute, he's suggesting that more tightening may be ahead. How are you reading that going into 2024?
So for the Fed, we are basically saying that the Fed is done now, but we think that they will hold on to the current policy rates until June 2024. That's when they begin to cut rates first. They do another 25 basis points in the third quarter, and then from there on, they cut by 25 bips every meeting, which takes us to 100 basis points of rate cuts in 2024. And 200 basis points of rate cuts in 2025. So what we have as a result of that in Asia, we are holding back rate cuts for Asian central banks, and Asian central banks also begin to take up rate cuts from late quarter of 2024.
But if the Fed does stay higher for longer, Chetan, to what degree might that constrain Asian central banks to be able to cut their own rates, and which of the Asian banks would you envisage having the most room to start cutting rates?
So you know, the Asian central banks actually do need to begin cutting rates already in the first quarter of next year, because we are seeing that inflation is coming down quite nicely, and we are getting into a dynamic where real policy rates in Asia are rising. And remember, Asia did not really have that big an intense inflation problem, so it doesn't need to keep real rates high like the Fed and ECB. So actually, they are in their right to cut rates, but they are being held back just by the fact that, you know, if they cut rates now and the dollar remains somewhat strong in our view in the first half, that creates a challenge with currencies depreciating, and then adding some upside risk to inflation. So to that extent, we are expecting Asian central banks to begin rate cuts as soon as you get a sense that the U.S. data is indicating that the Fed is about to cut rates, which is going to be in second quarter. And that's when we have first RBI and BI going in late second quarter of this year, next year. And then after that, we have BSP and BOK going in terms of rate cuts.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.